Hi everybody, welcome to our live Equalexes, and today I am talking to the wonderful Belina from Pāua Wealth Management. How are you today, Belina?
I'm good, thanks, Bridget. How are you?
Good. And so today we're going to talk about divorce and investing your money in the current environment. So you've worked in the banking and finance industry for 20 years in wealth management, personalized financial and investment services, relationship management, credit analysts, and risk management. Tell us more.
So I've been in this financial markets industry for more than 20 years. I have a broad knowledge of banking, of course, wealth management, and personalized financial and investment services. So what I do is I provide financial advice to clients, taking into account their unique situation, and put together an investment strategy and a plan that can help them to achieve their financial goals. Whether this be capital growth, capital preservation, income requirement, or succession planning. My portfolio of clients are typically private clients, individuals and families, as well as family offices across New Zealand and globally.
Fantastic. So what is a high net worth divorce from your perspective?
Generally speaking, high net worth divorce is one with a large amount of assets, substantial incomes, and typically they're more complicated. And they have complicated financial situation.
Yeah, absolutely. And why do you think they're more complicated?
Well, first of all, I'll put it out there. The divorce is challenging, or can be challenging experience for families, no matter what the circumstances are. Generally, the greater the wealth, the more complicated the divorce. But the emotional and financial consequences of divorce affect everyone that is going through a divorce. High net worth divorces can be more complicated because of the substantial amount of assets and income. And typically, these high net worth couples have more complex financial situation, and often they have non-traditional assets like businesses and companies that are difficult to value and divide. So the complexity is a result of the couples having more assets to fight over, and the stakes are typically a lot higher.
Yeah, that's absolutely right. So do people need a financial advisor during divorce? When's the best time for someone to engage the likes of yourself?
Good question, Bridget. Well, divorce is difficult, can be difficult for both men and women, financially and emotionally. The financial issues of divorce, when it comes to dividing assets, bank accounts, debt, can be very complex. So a financial advisor can play a key role during a divorce alongside the client's divorce team, people like yourself, divorce coach, solicitor. So financial advisor can help the client to think through their lifestyle, so that they can better understand the expenses before a divorce and after a divorce. It's especially important for people who have not been involved in paying the bills, managing investments, or budgeting. So the benefit of engaging an advisor is they can look at the client's assets, the income streams, and the projected living expenses objectively without the emotional cloudiness. And the advisor can work with the client, take into account the investment objectives, the risk profiles, time frames, to develop a strategy and a portfolio for the client. I would suggest engaging with an advisor as early as possible, so that they can help to simplify the process and also give the client confidence in the process. They will help to guide and make help you with the right financial decisions, and they can also help to reorganize your life and take control of your financial future.
I mean, because I see in my practice so many people who particularly women who are financially illiterate and
Yeah.
have no idea, when suddenly you're not managing the finances and you're now put into a position where you have to manage the finances. There's many mistakes that one can make.
Yeah.
I was one of those people who didn't manage the finances and did make some mistakes in terms of dealing with money. And everyone needs to know what they own and owe, and take responsibility and feel empowered when it comes to their finances, and actually be able to make money work for them. And that's where the likes of Pāua Wealth come on board and help people in that regard. So when is the best time to make a financial decision?
Well, the best time, divorce, is an emotional experience, as you've been through it. The emotional impact of ending a relationship is already difficult enough, right? The financial and lifestyle changes that result can just be as traumatic. So it is important, I think, first of all, not to make any hasty decisions, as the decisions made during the divorce process can have severe financial consequences. And you could end up regretting this, your decision in the future. So when you go through a divorce, it is easy, like you said earlier, to become overwhelmed by choice when your financial circumstances change. So it is important, in my view, to first of all let yourself embrace your emotion first, and then take the time to understand them before you make any financial decisions. Having a clear frame of mind is really important, and it'll help you to understand your responses to finances and wealth, and also help you create a plan that can set up structure for your long-term objectives, that will help you avoid costly mistakes. And you mentioned earlier going through it, having not have experience managing investments or money. The key thing is to understand that to people out there is not to be afraid to ask for help. Get help from qualified professionals like a wealth or financial advisor, an advisor that has experience working with clients like you will be important. So I think it's important, if you were to meet with an advisor, work with one that have experience working with clients like yourself. And the advisor can help you make good financial decisions that are thoughtful, that are aligned with your values and your long-term goals and objectives. And like you said earlier, an advisor that can take the time to educate you. And I thought it would be also useful, Bridget, on a sideline also to share with, for those clients that are new to investing and have not had experience dealing with an advisor, some of the things that they can do as an investor to protect themselves is, for a start, ask the right questions. You need to be sure that the financial advisor is acting in your best interest rather than their own. So some of the questions that you could ask an advisor could be things like, how do you generate your revenue as a firm? What are the risks associated with the proposed investment strategy? How are you personally compensated by proposing this investment strategy to me? Do you receive product commissions for recommending these investments to me? And also, question like, what is the governance process around how you manage investments? What is the basis of your investment recommendations? So, take the time to educate yourself and to understand the conflicts and capabilities of your financial advisors. And if you have any doubt, then that is not the right advisor for you. And if you have one already in place, then it's time to find another advisor.
Yeah, those are great questions. I hope everyone took note of those. What we'll actually do is I'll get your notes, Belina, and we will share them on social media so people know, can see what those questions are that you would recommend that people ask a potential financial advisor. So surviving financially after you've been through divorce is really difficult, as is taking control of your finances and investing. So how do people do it?
Well, I suggest, start by creating a spending plan or budget. Work out how much money you make, how much money you spend, what you need in terms of your living expenses, in your savings. So after a divorce, it is easy to let your normal spending pattern increase. So, or to forget that your new situation may mean that you need to cut back on your spending or spend less on certain things. So it's important to keep track of your spending. And if your income is not meeting your expenses, then I think this needs to be addressed urgently. So one of the biggest mistake that people make during divorce is trying to hold on to things that they no longer afford because of emotional attachment. And a family home is a good example. Becoming asset rich and income poor is not an ideal solution when you need income to live and to support yourself and your children financially. So an advisor can help you to work through the process and will hopefully come up with a solution to either generate income or reduce expenses. Set financial goals. I think it's important to sit down and put together a list of specific attainable goals that will help guide you in moving in the right direction after your divorce. For example, if you are starting over with little amount of money, then I think one of your key priorities would be to create an emergency funds that can help you to handle any unexpected expenses without taking on more debt or going into debt. And if you are in a position where you have funds available from your financial settlement to invest immediately, then you need to plan on how you are going to to invest those money, and seek help from a wealth or financial advisor before you start investing.
Yeah. Yeah. So we all know that in the current day, that there's a lot of market volatility, and people are really concerned in terms of what their portfolio, how much that's dropped. And so, what's your advice and approach on your clients' portfolios and how they're positioned relative to these really challenging times at the moment?
Well, the heightened market volatility that we've experienced so far this year, I think, has reminded investors that increased uncertainty unsettles the market. So looking at history, markets often overreact in the short term, but markets are resilient and they have generally pushed through challenges. They have powered through past periods of geopolitical market shocks. So it is important to remember that investors can still find opportunity in the midst of chaos, be it war, inflation, or recession. So during this time of increased uncertainty, it is important for investors to stay focused on their long-term investment goals. It's important to remember that the overarching investment strategy and construction of your portfolio drives the investment outcomes over the long term. So don't be disoriented by moments of crisis. This environment is a good time to evaluate your portfolio, pause, review, take stock of what is actually in your portfolio and how it will perform in the volatile market environment. So our clients' portfolio at Pāua Wealth are well positioned to handle volatility. We have been positioning our clients' portfolios using strategic asset allocation, including introducing an allocation to alternatives to fixed interest last year. And this has helped our clients' portfolio. And also our client portfolio are meaningfully diversified with a global focus, and they are predominantly active management. They have equity through developed and emerging markets, so it's very well diversified, incorporating a combination of growth and value strategies. This will help for the uncertain and volatile environment ahead.
Great. So I'm going to pick your brain now for some top tips. So for people who are investing or new to investing particularly, what would your tips be?
I think, try and keep, some basic investment principles in mind during challenging times. So there are a few tips that I'm happy to share to help, to help people avoid the common pitfalls and stay on track towards investing or achieving their financial goals. So market declines are a part of the economic cycle, right? So you need to accept declines as a normal part of the investment cycle. Historically, recoveries often follow downturns. So market has always recovered from declines. So keep in mind that selling your investments during a market downturn to reduce losses could mean losing out on gains when stocks recover. So you need to stay invested. Don't try to time the market. No one knows the perfect time to get in and out of the market. So consider holding quality investments that have the potential to rise in value over the long term. I think I read somewhere that recoveries, historically, returns in the first 5 years, return in the first year after the 5 biggest market declines, I think since 1929, ranges from 30% to something like 137%. And the average over that period is 70%. So over a longer term, the average value of an investment would more than double over the 5 years after a market downturn, after each market low. So if you try and time the market, you would have missed out on all this, potential. And I think the other tip that I'll share is try and look beyond the headlines. They're there to grab your attention, but it can be dangerous to let the media influence your investment decisions. You need to ignore the noise and stay focused on your goals, and avoid making.
You to get your advice from your trusted financial advisor.
Yeah, and then avoid making rash decisions during this uncertain period as well. So people tend to overreact, and you need to stay focused. Again, I'll repeat this again: stay focused on your long-term goals. And strong emotions during market swings can tempt you to do the things like buy high and sell low, and the damage would have already been done if you react to your emotions and you sell in fear. So you may also feel that doing something or anything during a downturn is better than doing nothing. Well, in actual fact, doing nothing sometimes can be better. You're better off. So investor who does the least, I feel, and choose not to be influenced by the actions of other investors will be better off during the long term. Diversification, Bridget, I think is very important. So make sure that you have a diversified portfolio. Different investments go up and down at different times. Spreading your money over a variety of investment types and regions can help reduce volatility in your overall portfolio. So consider investing in funds that is managed by fund managers that have proven long-term records and proven track records of success in downturns market as well as rising markets. And lastly, I would say, seek help and keep in contact with your wealth or financial advisor if you have one. And the advisor can put in place a investment strategy that can help to lock out the market noise, redirect your focus to your long-term goals, and they'll be there to help you avoid making decisions that could jeopardize your long-term investment goals.
Wonderful advice. So, Belina, thank you very much for your pragmatic insights. They were fantastic. If anyone's got any questions, please reach out to myself or Belina. How can people get hold of you?
Well, we've got our website is www.paawawealth.com, and my contact details are on the website and also available on LinkedIn as well.
Yeah, and they're also on our website, equalexis.com, and we will include those in this live content too. So yes, we will be back again. If anyone's got any questions that they would like to ask in advance of our next Facebook Live, do message us and let us know. And we hope you all have a wonderful rest of the day. And thank you once again, Belina, for joining us.
Thank you, Bridget, for having me.
Pleasure. Bye, everybody.